with me being a realtor, one of the things I really enjoy is being a resource for people.
Okay.
And especially when it comes to their house. So this is your realtor by design, Courtney with Wyker Realtors. And today I have the pleasure to bring my friend Mark Yecies, who's one of the founders of SunQuest Funding. Together they have over 40 years of experience. So he's going to tell us kind of what's going on with mortgages to help you find your dream home, and just give us a little update on what's going on with their company as well. And it's great to have him here. So
Thank
without
you.
further ado, you're very welcome, Mark. I'd like to bring Mark up.
Okay. All right. So tell me where you'd like me to start, because we got plenty going on right now.
So you said a mouthful there. So first, Mark, you want to tell us a little bit more about yourself? I gave him a brief introduction, but you want to tell them a little bit more first off about you, the founders, and
yeah. I'm a partner in SunQuest Funding. We're a residential mortgage banker. We finance 1 to 4 family homes for purchase or refinance, owner-occupied, second home, investment property. We do renovation loans. We do, fix and flip loans. But our main area of expertise is in residential real estate. I've been at it longer than I'd like to say. Courtney was nice saying that we have combined 40 years experience. I'm much older than that. And we like to think of ourselves as, problem solvers, as a resource. I sound like the guy who taught me the business a long time ago when he used to say, if I haven't seen it, it hasn't happened. I like to say that, but every day, every week, I see something that I haven't seen before. And the business is very complicated, and being able to navigate that, the mortgage business is important, to make the process less painful than it has to be. Is that okay?
No, that's perfect. That's exactly what people need, because I may help them look for their dream home, but essentially you all make sure it fits within their financial parameters.
Mm-hmm.
So like if you could tell people, or what would be the top maybe 3 questions you get when it comes to lending from prospects who are looking to buy a home?
Well, of course, the first question that everybody asks me is, what's your rate? And that's a loaded question. Okay. All our money comes from the same place, essentially, whether you go to, Wells Fargo or Quicken Loans or, Rocket Mortgage or, Guaranteed Rate or us. All our money comes from Fannie Mae and Freddie Mac. And that money is priced by Wall Street, because we close the loan, and then the loan is sold onto Wall Street through Fannie Mae and Freddie Mac or the FHA or VA or what have you. And Wall Street has an appetite for that paper only at a certain rate or yield. Okay. So if you ever go shopping for a loan, everybody's rate is always about the same, within 1/8% one way or the other. So if you're looking at the difference of 1/8% on a $300,000 mortgage, that's about $25 a month. Okay. So for $25 a month, which you'll never feel in terms of your lifestyle, how much pain are you willing to put yourself through if you're at a company that's not good at what they're doing? Okay. The second question people always ask me is, well, what am I qualified for? And my answer is, well, what you're qualified for and what you can afford are usually 2 different things, because most people are qualified for way more than they can afford. I mean, clearly there's exceptions to that, but most of the time people are, really qualified for way more, because, the back debt ratio maximum is around 45% of your gross monthly income. So if you're making to keep things simple, if you're making $120,000 a year, which is $10,000 a month, and you're qualified for a $4,500 a month payment, that is something that you cannot afford on $120,000 a year. So it would never make sense to take a $4,500 a month mortgage payment, because you're looking at a $600,000 or $700,000 mortgage. It just makes no sense. Okay, plus taxes and insurance and so forth. So those are the two big questions that I get asked, and we get into a little analysis about how much money you should put down, how much you can afford, where you're going to be in 5 years. Sometimes we get involved with the accountant or the financial planner or an estate attorney or all three. So to try and keep the process transparent, and the client knows that we're trying to do what's in their best interest, which is very important. Okay.
That's great. I love that. I love that you get so, I like that that you all get so involved and really want to make sure that you're giving the client the best service when it comes to their financial aspect with buying a house. I like that a lot. That's really good.
Right. I'm sorry, I interrupted. Most people look at a mortgage as separate from everything else, and it's really a part of everything else. So you have to make sure that it fits with the other things that you're trying to do. Exactly.
So do you have it? Is there a third one that might be of concern to people?
Yes. The other question I'm getting is, where do you think the real estate market will be in 3 years?
Ooh.
And my answer is, the closest thing I have to a crystal ball is the shape of my bald head. So, or they ask, do you think rates are going to go up or down? And they'll change. That's my answer. They'll change.
And that's what they do. They change.
Right.
And so in follow up to what you were piggybacking, and follow up to what you were saying off of your second response, when it comes to getting involved with what people's lifestyles are and where they might see themselves, when it comes to helping your particular clients, how do you help guide them? How do you help guide, investor differently than a move up person, or someone who's a first-time home buyer? Do you look at them any differently when it comes to what their specifications or their needs are when it comes to buying their home?
The rules don't really change that much, okay? And everybody's situation is unique. But one of the things that, we have to do at some point in the process is run a credit report. And a credit report is really, it gives you a look at somebody's lifestyle. And that tells you if somebody's got half a dozen credit cards that have balances on them, then you know that this is a person that lives a less conservative lifestyle, shall we say. So you have to leave more room. You wouldn't, even if you wouldn't stretch them into something that might be borderline, because they like to spend money. They like to do other things besides pay for a house. Okay. You have somebody who's got one credit card with a $200 balance and no car payments and no student loans or anything else. Well, they might be able to stretch a little more, particularly a young couple that's just getting started with their careers. We might stretch a little bit, knowing that they're going to be in a better place in 3 or 4 years. As somebody moving up with 3 kids, you're not going to stretch them, because they've got 3 kids, the expenses that go with that. They've got college coming up. They've got all these other things going on. So we're going to try and keep it more conservative. And then, of course, on the other side, if their house may have gained $100,000 or $150,000 in equity over the last 5 or 6 years that they've been living there, so that also would contribute to what they can afford, and that's a different variable. Most first-time home buyers do not have a large down payment, so we're playing. The game is a little different. The strategy.
Absolutely. Okay. And now, with most home buyers not having a large down payment in the state that we are in today with this pandemic, how have things changed for them in the funding industry?
Okay, well, a lot of things have changed recently. First of all, let me say that Fannie Mae and Freddie Mac and the FHA have not changed their guidelines. Okay, they have remained the same through this pandemic. However, most of the lenders have tightened guidelines, because even though Fannie Mae or Freddie Mac has not changed their guidelines, if these loans go into default too soon after they've closed, or even before they get sold to Fannie Mae or Freddie Mac, the lender is responsible for that loan, not Fannie or Freddie. So now they're holding a loan that they can't get rid of, they can't sell, that house is in default. So what they've done is we as lenders have tightened guidelines. So whereas before with an FHA loan, you could get a mortgage with a 600 credit score, now most FHA lenders have a 620 minimum, okay? Fannie and Freddie similarly tightened up, okay, and lower debt ratios, higher credit scores, a little less forgiving because there's still a little bit of a hangover from 2009. Even though it's 10 years later, it still affects how the industry thinks, and this is a good thing, okay? It's a good thing.
It's a very good thing considering what happened in 2009, I think.
Right. Yes, and one of the other, I just lost my train of thought for a second. I just left the station. Right. And one of the other areas that is tightened up dramatically is renovation loans, like FHA 203K loans and home style loans, where you want to buy a house and it may have been in disrepair or a foreclosure, and you need a renovation loan to buy it. So, sometimes just to turn on the utilities if it's a foreclosure. And most lenders have stopped doing those types of loans, okay, even though they're still available. Most lenders have stopped doing those types of loans. The other thing that's changed is that since our loans are sold on Wall Street as mortgage-backed securities, the mortgage-backed security market is much slower. There's a lack of liquidity. So right now, the Fed, the Treasury, is really the biggest buyer of mortgage-backed securities. And what they've done is they are buying. Fannie Mae has two loan limits. There's 510, which is a national limit for Fannie Mae loans. So they won't buy a loan with a balance of they won't buy a loan over $510,000. In high cost areas like where we live in Essex County, in New Jersey, most of North Jersey, New York, Connecticut, Boston area, and DC, there's what's called a high balance Fannie Mae loan. So between 510 and 765 is what we call high balance. And the Fed is not buying high balance loans. So what's happened is that the rates aren't as good for the high balance because there's not as much appetite for the high balance loans, okay? There is no secondary market for jumbo loans right now.
And so it's like amazing right now because you're answering all the questions that are running through my head. It's like, okay, what about a secondary loan for the difference? And
right. So right now, any loan over 765, your choices are very limited. You're stuck with one of the big banks, like a Bank of America or a Wells or a Chase, and they have tightened their guidelines up dramatically. Like for instance, Bank of America and Wells used to do a jumbo loan. They'd go like up to $1.5 million loan with 10% down. Now they're not doing any jumbo loans with only 10% down. You need 20% down. Wells Fargo announced that they're not doing refinances of jumbo loans. And the only jumbo loans they'll do for purchase are for clients with deposits of $250,000 or more, okay? And B of A is similar. They don't want to do Fannie Freddie loans. They don't want to do conforming loan amounts. So their rates are not competitive in that area because they're trying to discourage borrowing in the the 510 range up to 510. So there's been a huge ripple effect from this pandemic, and where we are in North Jersey, the real estate market, anything that's a commuting distance to Manhattan or Brooklyn is hot. Like we've never had a busier market almost than we're having now. but the rest of the country is not enjoying that kind of real estate boom. So overall, the real estate market is struggling through most of the country, which is not good. But we should be allowed to have our moment, because when everything was booming in other parts of the country after the financial crisis, we were struggling. So it's our turn now. We're allowed. How long it lasts, who knows? But, you know, in my opinion, New York City will always have employees. Millions of people will always work there. And, you know, we will have a real estate market here.
I agree. And I like the fact that you're also following up with so many things that we say even as realtors, because it's like, coming from the lending aspect, you have a lot of different brokerages you work with that bring in that look for lending for their clients, or clients that reach out to you directly. So it's
Yes.
definitely great to have an expert like yourself available to answer some of these questions.
Right.
Put people's mind at ease over here, here in the New Jersey Northeast section. So, and now, speaking of which, how has, you know, the COVID-19, the pandemic, how, even though you say we have a growth market, how have you seen, like, just during this time, the rise, the lows, and where you kind of see just a little glimpse of what you kind of see coming ahead? Not crystal balling it so much, so just kind of what you're looking at coming ahead.
Well, one of the biggest, and I'm going to back up a little bit from that. So one of the biggest issues that we have going on right now is there's a shortage of inventory, because people don't want strangers traipsing through their houses, which is completely understandable. Okay. And actually, in my opinion, right now, the shortage of inventory is actually a good thing, because it's propping up prices a little bit, you know, supply and demand. And the fact that it's propping up prices is creating confidence in the real estate market. Okay, so people are not afraid to go out and plunk their money down on something. We're starting to see more and more inventory come on the market, because people are realizing that there is a demand for houses, and they don't have to worry that they're going to lose their shirt if they put their house on the market. They're going to get a fair price.
Exactly.
Or maybe more than fair. And so, so from that perspective, the market's in a good place. Where do I see it going forward? Hopefully, I see it being steady, not for a while. This is such uncharted waters. I just don't know where we're going to end up. One of the things that concerns me is Americans, by and large, have short memories. So
yes, I agree.
So in the next, you know, probably 5 or 6 months, maybe 8 months, we're going to have a vaccine. And it's going to be widely available when it's approved, because they're already manufacturing 3 or 4 different vaccines, so that the one that works is ready when it gets approved. So once everybody gets their vaccine, and then they don't have to worry about dying from this disease, eventually things will get back to normal. Maybe not totally where they were, but they're going to get back to normal. And people will forget, and then we'll be back into a normal sort of market. Yeah. It's not going to be 6 months or a year, but, you know, 3, 4, 5 years down the road, you know, people are just, it's going to be a distant memory, and people are going to kind of forget a little bit, you know.
Yeah.
Pardon me?
I said I totally agree.
Yeah.
I totally agree.
Right.
There's a lot of different reports out there about how long it might take or won't take, and when it's really going to happen. Like, it might be steady for a little while now, and then it's really going to hit big. Like, you're really going to see the turn come next year. But again,
you mean in the real estate market, you mean, or
the real estate market in particular, only because they say sometimes you don't see the effects of things now that they probably won't happen, like, especially when it comes to when people have to sell their homes. Because, you know, right now there are people who want to sell and have to sell. And then we won't see the people who really have to sell because of the pandemic or something like that, maybe until next year. Okay. With the forbearance and so on. I mean, do you want to touch on the forbearance a little for a moment for people?
Yes, I do. Okay. So just because you're not making your mortgage payment doesn't mean your mortgage payment is not being paid. So let's say, for instance, you make your mortgage payment, I'll pick one of the big ones, to Freedom Mortgage. Okay. Freedom Mortgage is still paying the person that owns your loan on Wall Street. So the principal, the principal and interest is being paid by the person you make your payment to, which is the servicer. So the servicer is fronting the money. So if you don't pay your mortgage through a forbearance, and you know, some people need the forbearance, they don't have a choice, they have to do it, which I completely understand. But if you don't have to do the forbearance, you shouldn't, because you will not be able to get a mortgage again. It doesn't matter that it's not affecting your credit scores, it's still affecting your credit. Like I have a borrower right now that I had to deny a loan because he let his loan go into forbearance in the middle of his refinance. And the problem is that if a loan gets sold to Fannie Mae or Freddie Mac while it's in forbearance, they are charging the lender 7% of the loan amount.
Oh my.
Correct. So basically that's a 9% swing, because most of us work for 2 points on a loan. So if we're working for 2 points on a loan and then we got to pay 7 points to Fannie or Freddie, that's a 9% swing. Okay. So lenders cannot afford to pay 7% of a loan amount on every loan. So if you are in forbearance, you will not get a mortgage, period. It just, nobody will lend to you. And to put it in perspective, on a $100,000 loan, 7% is $7,000. So if our average loan size is somewhere around $400,000 in this part of the country, you're looking at a $28,000 penalty to the lender. They just can't afford to do that. They won't do it. So they will not lend to you if there's even a chance that the loan will go into forbearance between the time it closes and gets sold to Fannie, which is about a 6-month period. Okay.
Yes. Look, that right there was a lot.
Right. Well, did it make sense?
It made perfectly good sense to me. I just hope it makes sense to to everybody else, but it makes perfectly good sense to me.
Yeah.
Because they got to assess the risk that they're taking on. So
Correct.
That's what it comes down to.
Correct.
How much risk, and they're not going to take that much risk because they're to make money.
Correct. And I will say that it's a good thing that lenders today still remember 2009, because a lot of the people that are working in the industry weren't even here in 2009. So the fact that there is some pullback and some a little bit of a conservative view of everything is actually good, because real estate is the only thing we manufacture anymore to any extent. And so having the real estate market be healthy is good, because there's a hangover from real estate to many other industries.
Exactly.
Contracting, hardware, and so forth and so on. Restaurants, people move into a town, they go to restaurants, they go to the local stores. And if people can't buy real estate, the entire economy suffers.
Exactly. It's a domino effect, like how much
Yes.
real estate affects everything, and why things exist in that town or don't exist in that town.
Yes. Yes.
So,
Yes.
Totally agree. So this was amazing, Mark. I really appreciate you coming on and talking with me today.
No, it was my pleasure. Thank you for asking me. I hope the information I gave was good. But
oh yeah, it definitely was. Now, is there anything you like to say just to wrap things up?
Yeah, go get a mortgage. I need the money.
Exactly. Somebody come buy some properties. It's that time to put some lending. So
I'm sorry. I interrupted. I apologize.
I was going to say that if you could just please tell people how they could contact you, and of course I'll have it in my comments, but let them know for sure.
Sure. I was just going to say, if anybody has any questions, whether you're in the market or not, I don't care. I'm happy to answer them. My office phone number is 908-272-8330. Okay. And that's the best way to reach me.
Beautiful. Now, and one other thing, I know you're licensed in New Jersey, of course. Aren't you licensed in like some in Florida or?
Yes, Florida and New York.
Just so everyone knows, it's New Jersey, Florida, and New York. So not only, of course, if you live in Jersey, I want you to reach out to him because I want you to reach out to me as well. But
Right.
if you live in New York or Florida, he also covers, SunQuest Funding also covers those areas as well.
Correct.
So thank you so much.
Thank you, Courtney.
All right.
Have a great day. Stay safe. Okay.
You too. Talk to you later.
Yeah. Bye-bye.
Bye now.